Welcome to today's webinar on general business conditions. I'm Haley Chinander of the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Ron will be entertaining questions at the end of his presentation. If you have a question, please type it in the chat box on Zoom. We'd love to get your feedback at the end of this presentation, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. Now, we do have a disclaimer that the views expressed here are the presenters only and not those of the Federal Reserve Bank of Minneapolis or of the Federal Reserve System. Now, I thought I'd share a little bit about this survey before we begin. The General Business Conditions Survey is one of the largest surveys of business conditions conducted among the 12 regional reserve banks. This is really possible thanks to our partnerships with chambers, government agencies, and other business groups who send the survey to their contacts on our behalf. So a huge thank you to all of our partners who help make this possible. Now, regarding this survey specifically, the survey was open between January 17th and February 8th of this year. We received 535 responses from business owners across the district with a really good balance of responses from all states. We actually had a record number of responses from South Dakota and North Dakota, so huge shout out to those partners for getting the survey out there and to businesses for taking the time to tell us about current conditions. We also had a good balance of firms by different sizes and by sectors. Now, we do also have to say that these results are simply a snapshot of what businesses are telling us. This was not a representative sample, so we encourage everyone here to interpret the results of the survey cautiously. And with that, I'll turn it over to Ron.
Thank you, Haley. Appreciate that very much. I appreciate everyone's attendance this morning. Before I get launched into some of the survey results itself, I want to give just a quick shout out to Haley. Actually, she's playing a bigger role in terms of getting new partners and getting more responses. And I think she's been doing a great job. So I just wanted to acknowledge Haley's work on keeping this a really valuable survey for the Minneapolis Fed. And I hope our partners and I hope the viewing audience this morning. So what am I going to talk about today? Let me give you some quick takeaways of this survey so far. So in the most recent 3-month period, we're seeing that revenue and profit trends overall are continuing to slow. We are still seeing good demand for workers, and that's, I think, still a really positive sign. We are seeing that prices remain probably the biggest challenge in terms of what businesses are telling us. Higher interest rates are also becoming a bigger problem. Labor availability is still poor. I don't think that's a surprise to really anyone, and it is a top concern. And kind of related to that, wage pressure remains quite strong, which I think complicates the matter for employers. We are asking more about what else employers are doing in order to try to attract labor. Wage increases continue to top the list, but as I'll show later, you are really trying a lot of different things. And what we're hoping to find out as we go is which ones are really making an impact. And I think the good news out of this survey right now is the outlook has actually improved over the July survey, and the overall sentiment is net positive. So I think that is, despite all of the challenges, the fact that the outlook is net positive. It's not positive for everyone, but overall there's a positive sentiment to the entire group, and I think that's really notable. So let me get into some of the specifics. First, we'll cover revenue. And again, for those that might be new to this particular webinar, let me just quickly explain how I orient some of these charts. So generally speaking, red means bad, green means good or growth, and the deeper the color, the more on the margins they are. So what we do with the first question, the first content question, is we're really interested in quarterly revenue compared with 3 different periods: the prior quarter, the same period, the same quarter as last year, and then we want a little bit of an outlook, what's coming in the next 3 months. And how I read this chart here is that generally speaking, revenues on a quarter, they're both down on a quarter-by-quarter basis and year-over-year. A little bit more so on the prior quarter, and that might be some seasonality effects taking place there. I think the more notable, maybe the most notable one, is that on the very bottom one, the outlook is that there's actually optimism. I think that's maybe a signal to what the overall outlook is, in that more firms are are reporting that they expect revenues to increase net compared to this past one. And compared to last year, excuse me. We're also asking about profits, and unfortunately, I think the news here is a little bit more dour. Recent profits are down both quarter over quarter and year over year, and a little bit more persistently, a little bit heavier on the negative side. In terms of looking forward for the next 3 months, there's a little bit of an improvement, but it is still net negative in terms of what firms are projecting with regards to profits in the near future. So we also ask firms to give us a little bit of information about their firm so we can kind of splice and dice some of the responses. And for me, one of I think the more consistent measures that we found is looking at results by firm size, by full-time equivalent workforce. And what you see here, generally speaking, since we've been doing this survey, we have found that larger firms have seen persistently better results, and that's simply continuing with the survey. So as you can see here, the larger firms are seeing, I would say, persistently good growth still. And given the outsized role that large businesses have in our economy, that's actually how we can explain why we're still seeing net output growth. If people have been paying attention to the news, the fourth quarter results were out, they're almost 3%. So in terms of seeing net negative revenue growth, the fact that large businesses are seeing positive growth, that is probably how we explain how there's overall growth in the economy, but not for everybody. We're seeing that small firms seem to continue to be struggling, unfortunately. I also want to note that we don't have a huge sample of minority-owned firms. Those tend to be smaller also, and roughly 2 out of 3 saw negative year-over-year revenue trends. So that's something that I think we have to make note of, and something that the Minneapolis Fed feels is important, and we're going to keep tracking. So in terms of quarterly profits, it's really the same trend. Generally speaking, large firms are still seeing net profits, and that's good. The bad thing is that firms across every size category actually saw a more negative revenue trend, or excuse me, more negative profit trend than revenue trend. So the profits overall are declining kind of across the board. They just happen to be, again, a little bit more positive for larger firms versus smaller firms. So we also asked them to identify the sector they're in, and here I want to put a big caveat. Go back to the disclaimer. These are just some thoughts that I have. These don't necessarily represent the bank's view on how sectors are doing. In general, because we have small samples in this, I would ask that you interpret this pretty carefully. But what this chart says to me is that the finance, insurance, and real estate area has seen some negative growth. I don't think that's terribly surprising, given that real estate and construction really have probably been the 2 areas that have been hit hardest with the rise in interest rates. We're also seeing some slowing in the consumer areas. That might possibly be due to the fact that there's pretty strong growth last year at this time. And we also know that consumer spending is slowing a little bit, even if it's still pretty strong. So I think that might explain some of it. Then on the more positive end, manufacturing in general has been performing quite well. And in terms of agriculture and forestry, we know that commodity prices are good. So anyone in that area is probably seeing a little bit better financial circumstances than they did a year ago. Now for some other good news, in particular with regards to hiring and employment. And here I'll talk a little bit about some interesting issues that are popping up in this survey. So we asked them to describe their hiring demand. And as you can see, firms in general are hiring. There's less than 40%, about only 1 in 3 are not doing any hiring or cutting, about 40% that are essentially not hiring or cutting. And then you have everybody else doing some hiring, including 30% that are trying to hire more full-time workers. And I think that's, again, a continuing positive sign. Now, there is a little bit of pullback in terms of the overall hiring demand, especially for full-time. I would expect that seasonality likely plays some role in that. At being January, things are slower, at least for certain sectors of the economy. I would probably say that's why some of that pullback is happening. But again, overall, still a lot of hiring. And I would also point out that firms are telling us that their hiring to replace turnover has been going up fairly steeply of late. So if you go back to the January survey of last year, about 25% were hiring to replace turnover. In this survey, it was 39%. Now, again, they're not perfectly comparable because of the survey methodology, but we think it's a decent snapshot and at least roughly, probably accurate in terms of the overall trend, even if the specific numbers may not be exactly correct. So then the couple of things we ask about with regards to staffing is, tell us about what current staffing levels are compared to the previous quarter. And the curious thing here that's been showing up in our survey over time is that on net, almost no survey we've done has showed net a majority of firms actually increasing their staffing levels compared to the previous compared to the previous quarter. Now, the question is, how do you square that with the fact that we are seeing rising total employment pretty persistently in Minnesota? Well, I think the answer, again, goes back to firm size. Large firms are responsible for a more outsized share of overall employment. And as you can see here, you're seeing net growth in staffing among the big companies. And even 11 to 50 it's negative, but it's less negative than the overall results are. And that's because there are a lot of firms that respond that are 1 to 10 employees, and you're seeing more negative growth there. And so I think that's how you can see overall firms are struggling to increase their headcount, but large companies are having more success adding headcount, and because they employ more people, that's why we're still seeing net employment growth. And it really does suggest, it really points to the fact that hiring difficulty really rests with small companies. Let me show you one more chart just to kind of emphasize that point. So as you can see here, we also ask firms what their future staffing expectations are. And what you can see from the big chart is that there is very persistent optimism overall that firms are expecting to be able to hire more people, have higher headcounts going forward. Now, what actually happens is less positive. They're having difficulty finding actual employees, having trouble hiring them. And if you look at the smaller bottom chart, even among small businesses, they expect to be able to add workers going forward. It just kind of suggests that the actual hiring environment is very difficult, probably more difficult for smaller firms who tend to pay maybe smaller wages, maybe have slightly less generous benefits, things like that, where larger firms are able to better able to compete in that area. So let's talk about some of the challenges. I think the audience here is very familiar with many of these challenges, but let's talk a little bit about what firms told us. So we asked them to identify the two greatest challenges to their business, and inflation is the top concern. I don't think there's a lot of surprise there. That is a very challenging matter for firms to deal with. Labor tightness also persists, and the new thing here with regards to the previous July survey is that higher interest rates now are in the top 3, and it pushes the supply chain disruptions to number 4. And you can see that it is fairly significantly below, say, the top supply chain is significantly below, say, the price increases concern. I don't know that supply chain concerns have necessarily ebbed that much, but it probably is it's simply less of a concern compared to the other 3. So I am going to show you a slide later about supply chain concerns, maybe alleviating just a little bit, maybe not as much as this chart implies. So let's talk a little bit about some of the individual challenges here. We asked them to kind of ballpark what their non-labor input prices have changed and how the final prices to customers have changed. So you have wholesale versus retail here, left and right. And in terms of wholesale prices, firms are saying they're really not seeing a lot of relief, a little bit, but again, given margin of error and things like that, I would say this mostly unchanged, maybe a little bit on the positive side. There is more evidence that prices at the retail side are starting to flatten a little bit or get some relief in that area. That's good for consumers, obviously, probably not good for any of the business owners that are listening to this who are actually experiencing this, where wholesale prices are not going down, but they're trying to relieve a little bit of price pressure to their final customers. We also ask about the the change in supply chain disruptions, as I mentioned just a slide or two ago. And here, what you can see is that on net, supply chains do look like they're improving, but only slowly. This is not a wholesale improvement, for everybody. There are still about 25% that are seeing things still get worse, even if just a little bit, but a little bit more higher share, roughly about 35%, 33% that are seeing some improvement. So it's better than the opposite. But again, I would say supply chains are only getting somewhat better, and they're still particularly problematic for what I'll call high goods kinds of businesses like construction, those businesses that have particularly high levels of inputs. Unless all of them are getting better, even having one or two supplies and their supply chains not be good can really interrupt all of the production that goes around it. In terms of labor availability, I don't think there's any surprises here. We've known about labor availability problems for well before the pandemic, and they are still kind of locked in. They do appear to be improving a little bit, but I would say only modestly. You still have 75% that see their ability to get labor as either moderately or extremely difficult. That's a problem, clearly. It is moving in the right direction, but not particularly quickly. Excuse me. One of the things, though, with that labor availability, with that persistent labor unavailability, is that we know that businesses are trying an awful lot of things to try to attract labor. We're trying to get a better handle on that. This is something that is not well studied and not well investigated right now. And we're trying to learn more about these issues, and particularly about what is the most successful. We don't know very much about what things are the most effective to attract labor. We kind of assume that the things that are being tried more often are the things that are having the most effect, but we don't really know. But what the firms told us is that increased wages is easily the top thing that they're doing to try to attract more and better labor. But we're also seeing increased work and schedule flexibility kind of leap out from the rest of the responses as that next thing that's happening. But there are a lot of other things that firms are trying. And to the extent that we can learn more about this, we're hoping that we can communicate those messages to employers, to workers, so that job matching happens a little bit better. The other thing that I wanted to point out, again, in this competition between large and small firms, again, large firms, probably because of scale and other reasons, they are actually trying more of these strategies compared with small firms. Again, I don't think it's terribly surprising. There's just more ability to try things to see how it might impact labor force when you have the scale of a company that is 300 or 400 or 500 people than necessarily if you were a 2 or 3 person shop looking for a person. So I just wanted to point that out. It's probably not neither a good, bad, or thing for individual firms. They do what they can, but it is interesting to see how things are different as it relates to firm size. One of the things that the last chart just mentioned is that wages have been a focal point for employers in terms of trying to attract more labor. And what we're seeing is that strong wage growth really continues. I don't want to say it's plateaued yet. Among the really large increases, the greater than 5%, maybe that's plateaued, but overall we're seeing almost 80% are continuing to give wage increases. And again, from a firm size, more large companies are able to give wage increases, and they're able to give larger wage increases, and that matters when it comes to competitiveness. So in terms of the outlook, and I'm pretty close to wrapping up here, this is in my opinion, the optimism is that the fact that there is optimism among the 535 firms that we polled. In general, it saw a small improvement over the July survey, and overall it's moderately optimistic, which I think is a good sign, given that we are in what I would call an uncertain economic environment right now. Now, I should point out that there might be some possible seasonality to the results here. If you go back to the January 2022, it seems like there may be some seasonality that is factored in here, and it wouldn't necessarily be surprising because you have the coming of spring, and in certain sectors like construction, like real estate, that are not doing particularly well right now, you're moving into their busy season. So I think there might be some of that. Also, any of your tourism businesses, things like that. So there might be some of that as a factor for the optimism. But again, I still think the fact that there is optimism is a good sign for the overall economy, because if things were negative moving into the busy season, then I think we'd have even more questions. So a few final thoughts. So again, I don't think we can overlook the fact that right now revenues and profits both fell, and that's a worrying sign for any business. The good is that we're still continuing to see strong hiring demand. Actually, the ability to find and hire new workers is still very difficult, but hopefully, as labor availability possibly improves, that might improve. Inflation has been maybe curbed, but only slightly, more so at the retail level. There is a lot of rising concern about interest rates, and understandably so. Supply chain continues to heal, but I would say only slowly. Labor availability is an ongoing challenge, and it's compounded by wage pressure. It's good for workers, obviously, less good for the employers that have to try to make ends meet. And lastly, the outlook, the fact that the outlook has improved and is positive, I think is a good sign moving forward. So I do want to just mention quickly before we get into a few questions, I just want everyone to know about the other business surveys that we do. We spend a lot of time and energy and focus on doing outreach to businesses, so we do understand how current conditions look on the ground. President Kashkari is a voracious he has a voracious appetite, for anecdotes and for on-the-ground kind of intelligence. It's maybe less scientific, but it does really give us a good feel for how things are going. And so all of you out there that respond to surveys, I really appreciate it. But very quickly, we have a hospitality and tourism survey currently in the field now. We also have a construction survey that will be in mid-April. There's a professional services one in May, and then we'll do this general business one again in July. We've also been able, by virtue of the 4 that you see above, we've also managed to also get enough contacts to get a monthly pulse survey out there. If you happen to be interested in being on a panel for this, please let us know. We're always looking to expand that one, because it does give us something monthly that we can track over time that really helps us understand current business conditions. And if there are any business groups that are listening that would like to participate in future surveys, or you might be interested in this presentation to, say, your members, I have some contact information there for either Haley or myself. Happy to hear some from anyone that was interested in more information regarding these surveys. And with that, Haley, I would be happy to take a few questions.
Yep, so Ron does have some time for questions. If you have questions, please type them in the Zoom chat box. So let's start with this one. It says, Ron, you mentioned some differences in responses by firm size in a couple places, and I'm wondering how the outlook varied among firms of different size. Did you look at that? And if so, tell us about it.
Yeah, thank you. Great question. As a matter of fact, I did look at that, and now that I think about it, I probably should have put it on with the last slide. So I apologize for that. The good news, it's kind of similar to some of the other slides. Net, all of the firms have a net positive optimism. And it's just simply a little bit more optimistic as it relates to larger firms. So they're all net positive, but you see a little bit more optimism. And I think not surprisingly that large firms, because they've seen generally positive profits among the sample of large firms and positive revenue trends. So it's not surprising that maybe they're a little bit more optimistic than small firms, but even small firms had some net optimism in terms of the share that were optimistic versus the share that were pessimistic, still positive, less so, but again, I think it also speaks, to the resilience and the optimism of small business, that I think they've gone through a very rough period the last 3 years, and I think they've become more resilient. And so I think there is always the kind of that constant, things are hopefully going to get better from here.
Yep. All right. And next, someone was wondering if you've looked at differences in outcomes by state.
Yes, but I don't find them very reliable, only in the sense that it's hard to tease out because they tend to have a little bit different composition. Excuse me. They tend to have a little bit different response composition in terms of the sectors, size, things of that nature. Excuse me. And so for the most part, there are some similarities among states. There are some differences, but I haven't looked at them closely enough to kind of offer like what state is necessarily doing better, in part because state boundaries from an economy standpoint tend to be fairly arbitrary. Most businesses do business across state lines, etc. So I don't really have anything to offer in terms of what state was doing better from our survey responses.
And finally, we have someone asking that you referenced how the employment situation was good news, yet it seems that the unemployment rate and difficult labor market is a key contributor to the Fed continuing to raise rates. How do you reconcile this?
Well, that's a very good question, and it's something that the Fed is trying to wrestle with in the right way with regards to monetary policy. In terms of employment growth, I think what I think monetary policymakers are really focusing on is there employment growth strong enough to kind of reignite inflation? Now, we have seen inflation kind of level out, which is what we're hoping for. It's leveled out over the last 5 or 6 months. Now, we don't think that that's necessarily permanent. It's why we do pay attention to things like labor market growth. The fact that employers are having some difficulty, I think, is probably putting a lid on what employment growth might be. I don't know that we're necessarily trying to get employment down. I don't think that's our goal. Remember, the Fed's goal are two things: price stability and maximizing employment. Those are the two mandates from Congress. We're trying to do the first one while still managing total employment as best we can. And so, but our first goal is inflation. So if we happen to see softer employment numbers, that's not necessarily a bad thing, but it is always kind of a constant check of both, that we're trying to maximize that dual mandate as much as possible. It's maybe not a less satisfying answer than maybe the questioner was hoping, but I guess that's kind of where the position right now of monetary policy is really trying to focus.
And looks like we have time for one last question. Someone asked if the projections for the ongoing retirement wave, along with insufficient population growth, are accurate. Will this labor shortage be quite long-lived, potentially 5 or 10 years of a tight labor market?
It's hard to know where labor availability might be, truly positive for employers. As the questioner, I think, rightly points out, there's a demographic trend and also an overall labor force trend that is not positive in terms of suggesting that we're going to see labor shortages go away very soon. I think also this is I actually give talks that focus a lot on this. Labor availability is likely to hang around at least until we can either increase labor force somehow or increase labor force participation. In other words, among the share of people that are interested in work, what share actually are working. That has been declining for some time. It's a 25-year trend and went even lower during the pandemic. I think going back to one of my earlier slides, the one on what employers are doing to try to be more attractive, I think that is going to have a big influence on trying to increase labor force participation. Right now, a lot of people are saying they are not interested in work given certain circumstances. And I think employers have some role to play in that. I think public policy probably has some role to play in that. And I think we also know that some workers face a lot of obstacles. So to the degree that we can problem solve to make some work environments more conducive to encouraging people to work versus maybe stay home with children if they can't find daycare, and lots of other reasons. Right now, I think it's pretty clear that labor availability is not going to improve dramatically. Hopefully it can get better, but it probably is only going to get better slowly over time.
Great. Well, that's our last question for today. Thank you all so much for joining us. More information will be on our follow-up email to this event. And please remember to fill out the brief 3-question survey that will pop up in your Zoom window upon exiting. And with that, I hope everyone has a great rest of their day.
Thanks, everyone.